This episode of Balancing Acts, we want to focus on some year end tax planning, kind of getting ready for the fourth quarter and 2025. So, we have a very special guest with us today, Alana McNichol, who I have worked with for close to 20 years. Alana is the director of our tax practice services. She's an MBA and a CPA. She's passionate about helping small businesses, nonprofits, and individuals thrive through smart tax and accounting decisions. She's also proficient in cloud accounting technology and loves to help her clients implement software to reduce operational friction, which many find. She's volunteered at a number of nonprofits, including the chairing the Entrepreneurs Committee of the Financial Women's Association. She's a member of the National Association of Tax Professionals and the New York State Society of CPAs. Welcome, Alana. It's great to have you here with us, helping business owners today.
Thank you so much. It's an absolute pleasure to join you.
And so the first topic I want to talk about is just, let's talk about compensating yourself. All business owners have to pay themselves. And there's different types of entities. There's S corporations, sole proprietors, LLCs, and partnerships. So can you talk about the key differences in how an entrepreneur should pay themselves depending on their business structure?
Well, you hit it at the beginning of this question, which is really entrepreneurs should pay themselves. I was speaking with an entrepreneur last week, actually, and she had a budget for her business that she was trying to launch, and paying herself wasn't even a consideration in that budget. And we all have passions, we all have products, we all have visions that we want to bring to market, but we're also looking to get paid, right? So, I mean, I think don't lose sight of that as a business owner, as an entrepreneur. So now diving into kind of the nitty gritty on taxes, like you mentioned, Linda, we've got sole proprietors, we've got LLCs, and we've got S corporations, which are sort of the main buckets of how your business might be structured. So a sole proprietor, we're either unincorporated or we've got a pass-through entity where there is no separate tax return filed. Everything shows up on your personal tax return. And then in an LLC or an LLP, you've got a business entity and you have probably more than one partner. And finally, in an S corporation, you're incorporated, and then you filed an election to be an S and report things on your personal tax return. So as a sole proprietor, you can take money out whenever you want, and it's not going through a salary, right? It's simply a draw on the company. And the same is true for an LLC or an LLP versus an S corporation where it is truly a wage, right? So you're getting a W-2. When you are taking a salary from an S Corp, you're sort of treated more like an employee despite being the business owner.
Right. And you actually are an employee. And actually C corporations, there might be some people listening who are organized as a C corporation, a regular corporation, instead of an S corporation, which is for tax. And they too are treated as employees. So how about the tax implications of a different method? Why don't we focus on S corporations for a moment? How do they take that? How do they decide what the salary should be?
Yeah, it's a great question. And one of the reasons that it's a focal point for us right now is that the IRS is focusing more heavily on S corporations and compensation in particular. So when you are an S corporation, you need to pay yourself what is called a reasonable salary. And a reasonable salary conceptually is how much would you pay an employee to do the work that you are doing, right? So if you were hiring somebody to do the job that you are doing as the company owner, what would the salary be? And that is not just picking a number based on how much money you're making, for example, right? That is actually, what are my job duties? What are they worth? And that is what your reasonable salary should be. And I think one of the things that S Corp owners don't necessarily understand is they cannot take money out of their S Corp unless they have paid themselves that reasonable salary, right? So if your reasonable salary is $100,000, you've got to pay yourself on a W-2 that dollar amount before you start taking money out in other ways, such as a distribution.
Right, right. And distributions, for those of you listening, means taking money out. Sometimes your accountant will call it a distribution or a draw, but essentially you didn't take any payroll taxes out of it. There's no withholding. You've just taken the funds out. And clearly that that can create a problem. What happens if you take distributions and you haven't taken a reasonable salary yet? What's the consequences of that?
Well, and when we talk about distributions, it's not always just pulling money out of a bank account. Some S-Corp owners will randomly pay a personal bill through their S corporation or do some other kind of fund commingling transaction that ends up being looked at the end of the year. So the IRS will come in and say, hey, these distributions that you took tax-free should have been salary. And they will actually penalize you for not paying yourself salary. And of course, for not paying in payroll taxes. The government wants their Social Security and their Medicare, and they will penalize you if you don't actually pay into the system through a salary. So it's really, again, enforcement is looking at this a lot more closely than they have in the past. I have heard from other practitioners that they're seeing this be challenged on a federal level.
Right. So they're challenging. We think you shouldn't have taken that much distributions. It really should be salary instead. And that's what's important to talk to your own accountants about. So the last thing I want to ask about this same topic is, okay, I've decided my salary should be $60,000 and, I wanted to take 20,000 in distributions. How do you keep a record of the 60? What do you need? Do you need a piece of paper? Do you need an agreement? What should you do to actually document that?
Yeah, so what we do in our practice is we actually use a piece of software that generates a reasonable compensation study. And that is based on a detailed interview that we do with a business owner to understand what they're doing for the company. And of course, when you're the business owner, it's not just working on the company, it's also working in the company, right? So you may be managing the company and doing the work to deliver the services that you're providing. And it is about having substantiation. It is about having a document in your records contemporaneously, right? You're setting that salary. Ideally, you're setting it every January, right? New year, what's going on in the company? Am I doing something different? Should that change my compensation structure? So you need to put some thought into this. And I think it's very easy to just say, I'd like to make 100K this year. But it's a lot deeper conversation than just pulling out a number that sounds good to you.
Right, right. And then, as you mentioned, as long as you don't take distributions, there really aren't any consequences to taking less because your salary is already the most the company can pay you. What about LLCs?
That's the other side to this is that if you don't have the profits to take the salary, then you also don't have a problem, right? It's that you're taking cash out of the company and you're not putting it through payroll and you haven't hit your reasonable salary number, right? That's when you're going to have an issue.
What other benefits would you like to mention that business owners can take, whether they're S-Corps or LLCs? What can you recommend?
Yeah, we did a deep dive onto S-Corps here, but in terms of benefits, I think what I really hate to see is that people who start a company, own their own company, are not funding their future. And of course, I'm talking about retirement benefits. When you're a W-2 employee, it's very easy to just check the box and say, yes, start funding my 401k, right? And it's sort of a set it and forget it. And you are truly creating benefits for your future self. And I think when you're a small business owner, you've got to be thinking that way. I mean, the great thing about owning a small business is that there are many different kinds of retirement accounts that you can think about. But this is a conversation to have with your advisor sooner than later. I think setting the habit, making it part of the way you think about your own compensation is really important.
Yes, I completely agree. Anything you want to say about LLCs on how they get paid, especially maybe if there's a partner? If a single member LLC is more like a sole proprietor, but what about if there is more than one owner? Do they have to follow any specific rules like S corporations do?
Sure. So an LLC or an LLP, when you have partners, you're not getting a salary in the same way, right? You're not getting a W-2, you're not getting a paycheck, you're not paying into the payroll system. You are taking money out of the company. It's usually called a guaranteed payment, and it is subject to self-employment taxes, right? So that's, a difference structurally than on the employee side. And I think on that note, tax planning wise, a lot of my clients who are in a partnership structure don't always think about paying into the system as they go in a way that a W-2 paycheck does, right? So you are self-employed, you're responsible for those self-employment taxes. You've got to think about where you're going to end up in the year, and you've got to pay in quarterly. And I think we hear about those surprise tax bills because business owners really aren't looking at the big picture of how they're taking money out and how it will be taxed.
Great. We're going to take a commercial break in a moment. I just want you to remember from this segment, if you're an S corporation or a C corporation, you want to make sure you have a method of documenting your salary to avoid penalties and understanding the difference. Have a conversation with your accountant. Make sure they explain this to you. And we'll come back and we're going to talk about reporting beneficial ownership and the new Corporate Transparency Act.